Hi, in this video we're going to talk about Chapter 5, Transfer Pricing and Various Cost Allocation Techniques. The objectives of this chapter is to explain the four objectives that an appropriate transfer pricing system should accomplish. We're going to talk about both qualitatively and quantitatively explaining different methods of transfer pricing and their advantages. We're going to talk about some key considerations that management needs to discuss when they're administrating transfer prices. We're going to talk about shared centers and what are the characteristics of shared centers. And then we're going to discuss how management controls considerations are related to shared service centers. So transfer pricing is a method of accounting for the transfer of goods or services from one responsibility center to another. So this is when you have profit centers. So the transfer price of one responsibility center is its revenue, and it will become the cost for another responsibility center. So think about production and sales. If production creates a transfer price for sales, it's going to do cost plus some profit level, and then that is going to be used to evaluate their profitability and performance. And then the sales department's profitability and performance is going to be looking at the revenue received from the customer versus the transfer price that they paid to the production facility. So here you're trying to allocate some value to each department in the chain, and there might be some shared services that we're going to discuss later on. Transfer prices provide each business unit with the relevant information it needs to determine the optimum trade-off between company costs and revenues. It should induce goal-congruent decisions, so decisions that are good for the organization as a whole, and they tie back to always our mission, vision, strategy, and goals. It should help measure the financial performance of individual responsibility centers. So as I mentioned in my example, you would have a measure of profitability for the production unit, and then you can have a measure of profitability for the sales unit. The system should be simple to understand and easy to administer. You don't want something overly complicated. And it should also be acceptable by tax authorities, so you're not duplicating and replicating and creating different approaches just for tax authorities. When we think about transfer pricing, we always think about this fundamental principle, and this is that the transfer price should be similar to the prices that would be charged if the products were sold to outside customers or purchased from outside vendors. The key to that is you want to make sure that that transfer price is competitive, that one profit center isn't falsely making a profit off of another. But you always have to consider the following thing. So you have the sourcing decision. Should the company produce the product or purchase it from an outside vendor? Costs aren't the only things that come into play with the sourcing decision. You're always thinking about whether or not you have any intellectual property that you don't want to share. You're also looking at your investment in assets and your asset utilization rates. If you've purchased the equipment and you have excess capacity, why are you going to not utilize it unless you can sell it? So remember, there is more than just looking at the bottom line. You have to look at the organization as a whole. We also have our transfer price decision, which is If it's produced, what price should the product be transferred to between investment centers? So what is a rational and reasonable transfer price? If we had the perfect world and we had an ideal situation, a market price-based transfer price will induce goal congruent behavior if all the following conditions existed. If we had competent people that did their job well, if there was a good atmosphere where the organization worked as a functional unit and there wasn't any dysfunctional behaviors, there was a market price that could be evaluated and referred to, if the organization had the freedom to either purchase in-house or from external sources, if there was full information where everyone knew everything, and there was the ability to negotiate a fair price. However, we rarely have an ideal situation, and most companies will experience some constraints on sourcing. For example, you might have limited markets, so there might be limited internal capacity to develop external sales and external consumers for various profit centers, because they have a lot of demand from internal centers, and maybe the strategic objective of the company is always to satisfy internal demand before satisfying any external demand. If the company is a sole producer of a differentiated product, then no outside sources exist, so it is challenging to figure out what would a fair market price be. Or if a company has invested significantly in facilities, it's unlikely to use outside sources because they've purchased these assets. They made this capital investment. It's not good for an organization as a whole to have idle capacity. So here is where you're not only looking at the responsibility center on its own, but you're taking a big picture view of the organization as a whole. And sometimes there's excesses or shortages in the industry, and these affect the ability to source and price products. When we think of transfer prices, we need to make sure that they are competitive and that they best satisfy the requirements of the profit center. So to establish a competitive price, if there are published market prices, they should be referred to. If there are various vendor bids, those should be looked at. The price the selling profit center sells to outside markets can be used as a starting point for the transfer price. Or if the center that's buying sometimes purchases from outside vendors, that outside price can be looked at. So it's always nice to look at an objective price as a starting point to see what would those products and services be worth in the outside market. Now let's look at a cost-based transfer price. The cost-based, the usual basis is standard cost, and when you're deciding a cost-based standard transfer price, you should consider the following things. How is it best to define the cost, and how are you going to calculate a profit markup, and what should that markup be? The profit markup, some things you should consider is the profit markup based on the percentages of cost or the percentages of investments into that center, and which level of profit should be allowed, and which level of profit should be best for the organization to meet its objectives overall, and not just the profit center. You want to make sure that on an organizational level, you're making the best decisions and not just at this profit center level. There are different ways to transfer price. Sometimes you might have an agreement between the two business units on what the pricing should be. You can use a two-step transfer price where you charge a variable cost, a fixed cost, and a markup. And you look at the capacity that the departments promise each other. There could be profit sharing or two sets of prices that are then credited back to headquarters. Now let's look at an example. Here we have a restaurant who's supplying to a hotel. The estimated amount of meals required is 5,000. We have a variable cost of £5 per meal. The restaurant seems to have a fixed cost of £20,000. They have a working capital investment in facilities of 1.2 million. They would like to earn a return of 10% on this working capital investment. So the way they determine the transfer price is they take the variable cost per unit, calculate a fixed cost per unit by dividing the £20,000 by the 5,000 meals. Then they figure out their profit. Their profit is a 10% return. The investment was made for the year. So here, as we can see, they divided by 12. So to figure out how much it is per month, and then per meal. So there's a $2 profit baked in. So our transfer price for this particular example is £11. When it comes to transfer pricing, there are administrative issues that all management should consider. Negotiation and the negotiation power of the parties that are setting the transfer price. You have to make sure that they have even power so one party doesn't exert too much control or dictates an unfair transfer price. There should be some kind of methods of arbitration and conflict resolution in place in case the parties themselves can't negotiate a price and they're at an impasse. And there should be various product classifications available. Now let's look at some corporate services or shared services and how those costs can be allocated to various profit centers. Functional services include central accounting, IT, human resources. These are support functions that assist the organizations as a whole. The advantage of allocating these costs is that it enables accurate calculation of the prices of goods and services produced by decentralized units. The other advantage is that allocation of these costs raises managers' awareness of the services that are being provided and the costs associated to those services so that they can make the appropriate decisions when using these services. And allocation creates a healthy tension between central and non-central managers. The main disadvantage is that allocation of non-controllable costs may be perceived as a corporate tax and unfair because sometimes organizations don't have control. However, if you provide profit centers the opportunity to source those support services from external vendors, then they may see these allocations as more fair. For example, you are either able to use our centralized IT unit or you can use an external IT vendor. And as long as the pricing between those two are competitive, then allocation shouldn't be perceived as a problem. When we discuss corporate services and pricing, Sometimes identification can be easier, and two types of transfers can exist. One is for central services that receive units that can be partially control the amount used, or centralized services that the business unit can decide whether to use or not, as I mentioned in the previous slide with the IT example. When we discuss the control of services, oftentimes the unit manager cannot control the efficiency with which activities such as IT and R&D are performed, but they can control the amount of those services received. So how much IT support they utilize, or how much accounting or reporting support they get. In those cases, you can pay the standard variable cost of the discretionary services, the full cost, or a market price. If there are external vendors, there could be a market price used. Those services, as I mentioned, can be optional. So the business unit responsibility center manager may decide to use internal IT or an external vendor. And there should always be simplicity to the pricing mechanism. You don't want to create contracts that are too complex and require too much effort, because then you're hiring additional workers and you're creating a lot of complexity. So simplicity is always key. Now let's talk about shared service centers. These are a subset of non-core business functions that are concentrated into a new business unit. Common areas that are put together are usually HR management, accounting and finance, legal, advisory, and IT. And these generate the advantage of economies of scale. They might improve clarity about strategic alignment. They could be more consumer focused, and they could create higher quality and service improvement, and employees can build specialized skills, but they may fail if they're cost more than planned. I have an example from my work. When I was working at Vale, at the beginning we had individualized support services at each geographical area. So Canada had its own accounting, legal, IT. Brazil had its own accounting, legal, IT. China had its own accounting, legal, IT, and so on and so forth. And then Vale tried a shared service model where all the accounting, IT, HR was consolidated into one building, and they served all the geographical areas as one own. However, it didn't work because of language barriers, coordination, etc. It turned out to be more expensive, but in some organizations it works well. The key is to have a plan and a vision and mission. Let's discuss management control systems and shared services. Remember that shared services are not the same as centralized service units, and this is because they have full responsibilities for financial performance and the quality of services. They operate as either expense centers or profit centers. They're normally financed by the fees charged to the business units, and they take strategic direction from top management by forming close relationships with the business units that they serve. When it comes to shared services, top management is still very important, and it is very essential to decide what are core and non-core activities. It needs to be explained and justified clearly why shared service centers are implemented. What is the advantage and benefit of these service centers? Top management must decide whether it will allow business units to purchase support services from outside the organization, or will they be required to use the shared services only? And then when it comes to the shared services, are they just serving the organization as a whole, or are they able to sell services to outside customers, especially if they have excess capacity? When we are thinking about shared service centers, it's important to determine the level of service that business units need, and also what are they willing to pay for the services that are provided, and this will assist in creating a fair transfer price. There always needs to be a balance between service quality and costs, and oftentimes when you have shared services, you will have service level agreements, and these should include both financial and non-financial measures such as productivity and customer satisfaction to make sure that you can properly evaluate shared services and their management. Here we see the difference between a central service department and shared services. On the top, we see a central service department that reports directly to the board, and then we have various business units. And what you will see here is that the central department is quite different. And we also have these local service departments that serve the business unit, and the central service department serves the board. In contrast, if we look at the organizational chart below, we see a shared service unit that is shared by the entire organization. So the board uses it as well as the business unit. So you have one central service versus the service department located in different areas. Now let's talk about some of the challenges with interdependent responsibility centers. The nice thing with responsibility centers, as we talked about, is that there is the controllability and everyone's trying to maximize their revenue. The problem is that you might create an agency problem where you have the principal and agent and everyone's working on their own best interests and nobody's looking at what's best for the organization as a whole. So you might create competition versus alliances. Then it's always challenging to manage service level agreements because oftentimes they become onerous documents with a lot of clauses. And it is impossible to think of every contingency. So how are you going to deal with deviations from the service level agreement? What are the dispute resolutions? How are prices being set? These are very complex issues that might take a lot of time and effort. And then you have to think about transfer prices and tax. Oftentimes transfer prices might be set at a disadvantage of one responsibility center over another because it's better for the organization as a whole from a tax perspective. For example, if you have a lower tax region versus a higher tax region, you want to show that lower tax region as more profitable because the company will pay less tax. And remember, most organizations want to maximize shareholder value, and that might include reducing immediate tax-related expenses. You need to also think about how to optimize managerial decision-making overall. And then how can you adhere to the arm's length principle when you are talking about members of the same organization versus different organizations? Thank you. If you have any questions about transfer prices, please send me an email and I will be happy to help you. Have a great day.